$17 billion just became worthless. And anytime that much money essentially vanishes, the lawsuits come soon after. On March 19, 2023, UBS bought Credit Suisse for $3.2 billion. Credit Suisse was a steaming pile of and the Swiss government badly wanted UBS to step in and buy the bank. But if UBS was going to do it, there were going to be requirements, ones that would help UBS and completely destroy Credit Suisse.
Where I go, destruction will follow.
One of these requirements was that the Swiss regulator would agree to a write-down of a tier of investments. And with the stroke of a pen, $17 billion disappeared into thin air.
And it's gone.
In this video, I'm going to break down what happened over the last few days and the lawsuit that was just filed by the people who effectively got their money stolen. After Silicon Valley Bank and Signature Bank collapsed in the United States, all eyes were on Credit Suisse. The bank had been losing money for consecutive quarters, largely due to the ramifications of the massive money laundering that went on at the bank. People were pulling their money out of the bank and placing it in banks that had better reputations. Credit Suisse was seeing at one time $10 billion in withdrawals per day just last week.
That's a lot.
See, in the banking crisis, all people want to know is who's the next domino to fall so they can pull their money out before the bank goes bust. Over the past weekend, Credit Suisse was looking like it was going to be the next bank to fail. It was the second largest bank in Switzerland and one of the 30 global systemically important banks. These are banks that are important to the financial system, and if they collapse, it would shake the financial world. Well, Credit Suisse was about to be an earthquake.
Everything just kind of collapses.
To prevent this, the Swiss government essentially pulled UBS into a room and said, "You gotta save this bank. We can't have it go under." But the Swiss government was at the mercy of UBS. It's like trying to bargain with the lion. You may think you have a say, but we all know the lion has all the power. UBS knew that taking on Credit Suisse was risky, but at the same time, there were benefits. Chief among them being that UBS would then be the country's biggest bank by a mile, and therefore be able to dictate government policy. But they also knew that they could shape the deal however they wanted, because the Swiss government was at their mercy.
I'm sure you're scared, probably in debt. That's the best offer you're gonna get.
UBS would buy the bank, but they wanted to trim the fat. Specifically, what UBS wanted to get rid of was additional Tier 1 bonds. These are a special kind of bond that financial institutions issue to meet their capital requirements. Now, these bonds are perpetual, which means they have no maturity date, kind of like a piece of gum that you keep chewing and chewing, but it never loses its flavor. Additional Tier 1 or AT1 bonds are relatively new. They're like the wild side of the financial world. A little bit risky, a little bit controversial, but also kind of important. So the backstory on AT1 bonds is that after the 2008 financial crisis, regulators were like, hey, banks need to hold more capital to protect against financial instability. And so they introduced Basel III, which were a set of international banking standards that require banks to meet certain capital requirements. But meeting those requirements wasn't as easy as just stashing some extra cash under the mattress. No, banks needed to get creative. And that's where AT1 bonds come in. They're like a fancy new tool in the banking toolbox, designed to help banks meet the regulatory requirements while also providing some extra protection for other creditors in case of trouble. But here's the thing, AT1 bonds are not your average run-of-the-mill bond. They're more like a hybrid of debt and equity, like Frankenstein's monster, but for finance. And they have a special feature that makes them extra fun. They're loss absorbing. Now, what does that mean? Well, it means in the event of a financial institution's financial distress or insolvency,
but we don't have the money,
the bonds can be written down or converted into equity, essentially absorbing losses and providing a cushion for the institution's other creditors. So it's like a sacrificial lamb. It takes one for the team. But here's the kicker. Investing in AT1 bonds can be risky business. They're high-risk securities due to their hybrid structure and the potential for write-downs or conversions.
You risk too much.
Now, before I go on, let's dive a little deeper into the difference between write-downs and conversions. Here's the deal. When a financial institution is in trouble, like when they're hemorrhaging money faster than a leaky faucet, they might need to take some drastic measures to stay afloat. And one of those measures might involve writing down or converting their AT1 bond. Now, writing down is just a fancy way of saying that the value of the bond gets reduced. It's like when you buy a cake, but then you drop it on the ground and it gets all smushed up. The cake is still technically there, but it's not worth as much as it was before.
I'm serious about this stuff.
Same thing with the bond. It's still there, but it's not worth as much as it was when you bought it. On the other hand, conversion is a whole different ballgame. This is when the bond gets turned into equity. Essentially, it becomes a share of the company. It's like when a caterpillar turns into a butterfly. It's still technically the same thing, but it's also something completely different. And if you're an investor who thought you were getting a nice, safe bond, but suddenly you're holding a share of a struggling financial institution, well, that might not be what you signed up for. Write down means the value of the bond gets reduced, while conversion means the bond gets turned into ownership of the company. Now, fast forward to March 19th, 2023. When UBS was in the negotiation to purchase Credit Suisse, UBS wanted those AT1 bonds essentially wiped out, which is possible by law, but only after equity, aka shareholders, were wiped out and the bank capital comes below whatever percentage is stated in the AT1 agreement. Once that happens, the bank can wipe out the bonds. But that's not what happened. Credit Suisse did not fail. The bank was purchased for less than 30% of its prior value. Since it was a sale, shareholders in the company would have to absorb the losses first. The shareholders lost money for sure, but as part of the deal, they were going to be paid out, albeit a smaller amount than what they expected. But that was only because Credit Suisse sold for a significantly lower price than what it was trading for just 2 days prior. The bondholders were screwed.
I'm screwed.
The bond agreement contained a clause that allowed the Swiss authorities to write down the bonds to zero if the bank was no longer viable. Now, the Swiss are going to say that the bank was no longer viable and thus they were allowed to write down the bonds. But I strongly disagree. If the bank had actually failed and was purchased for $1, like the UK arm of Silicon Valley Bank, then yeah, I'd consider the bank to be no longer viable. But buying something for $3.2 billion seems like there's a lot of viability left. International law firm Quinn Emanuel would agree. They gathered a team of lawyers to explore suing Credit Suisse, UBS, and the Swiss government. And what makes the case against the Swiss regulators even stronger is that in order to get the Credit Suisse purchase through, they had to change the law.
One of you is describing literal fraud and the other is demanding credit for global financial terrorism. As your attorney, I have to advise you that I will be plugging my ears for the remainder of this conversation.
On Sunday, March 19th, the Swiss authorities changed the law that would require UBS shareholder approval to have the purchase go through. So clearly something fishy was going on. And once news got around that these AT1 bonds could be erased rather easily, might I add, investors rushed to get rid of AT1 bonds held at other institutions. But to calm investor fears, a couple of regulators are publicly stating in an eloquent way that what the Swiss did was wrong and they won't do the same. For example, the European Banking Authority issued a statement saying that what happened with Credit Suisse was a one-off. By the Swiss trying to calm the markets with the purchase of Credit Suisse, they made an entirely new problem that will take years to settle in court.
Extraordinary events call for extraordinary actions.
But why would the Swiss government do this? They had to have lawyers on the payroll. I have one idea and it may ruffle a few feathers. The largest shareholder of Credit Suisse was the Saudi National Bank, who owned 9.9%. Followed by Qatar Holding LLC, which owned 6.5%. The Saudi National Bank had been injecting more and more money into Credit Suisse in the months prior to the sale. And I'd wager the Swiss didn't want to upset these two shareholders by having their investment go to zero. So where do we go from here? The Swiss government is going to be facing multiple lawsuits, and the Swiss people are actually going to bear a good deal of the financial burden. But this all could have been avoided if Credit Suisse stopped being a haven for money laundering. And in this video here, I break down some of the many money laundering cases the bank was involved in and how that ultimately led to its collapse. If you're not really sure why Credit Suisse fell, look at this video right here.